Mr. Chairman, I want to talk about corporate bond buying because when we put together the CARES Act, the concept of funding SPVs so that they could go out and buy corporate bonds, whether through ETFs or whether through a new Fed-created index or directly, there were always two reasons for having this capacity. One was to ensure the smooth functioning of the markets. And for that, the mere existence of these programs has been remarkably successful. We've seen record volumes of corporate debt issuance. Clearly, the corporate bond market is functioning and functioning very, very well. The second possibility was to provide liquidity to a company that's fundamentally solvent, but facing a serious liquidity problem because of the nature of the moment. It seems to me that continuing broad-based corporate buying of bonds now, and including setting up yet a new index for doing so, doesn't serve either of those purposes. Those needs are being met, and I worry that it starts to look a lot like fiscal policy, or it starts to look a lot like the goal is to lower spreads, despite the fact that nominal rates are incredibly low. And it certainly seems to me that this kind of activity at a time when the markets are already functioning smoothly and we're not addressing individual borrower needs, but rather making these broad-based purchases, we run the risk that we diminish price signals that we get from the corporate bond market, which can be extremely important in enabling us to detect problems. So I'm wondering why we need to be continuing a broad-based corporate bond buying program now, and what's the exit strategy on this?
So I certainly hope it doesn't have those negative effects you mentioned. This is something we said we would do at the beginning, and you pointed out that markets reacted very strongly to the announcement. That's because they believe that we'll do what we say we're going to do. So one reason, I wouldn't say it's the main reason. One reason is, though, we feel that we need to follow through and do what we said we were going to do. So that
could I just on that, my impression had always been that it was a contingent thing, that this would be there as needed and would be used as needed. But if it's not needed, it's not clear to me that you have to use it anyway to show that you're willing to use it. I don't think anybody doubts your willingness to use it.
So we're not actually increasing the dollar volume of things we're buying. We're just shifting away from ETFs toward this other form of index. And as we've said, and if you look at the FAQs, frequently asked questions we published associated with this change, it's really going to depend on the level of market function. If market function continues to improve, then we're happy to slow or even stop the purchases. And if it goes the other way, we'll increase.
Is there a problem with market functioning now in the corporate bond market?
Market function has improved really substantially, and that's why you see very little demand. In fact, so far, no demand at the primary market facility. We originally thought that was where the demand would show up. So we're just, it was out of an excess of caution to preserve these gains for market function by following through. And I don't see us as wanting to run through the bond market like an elephant, doing things and snuffing out price signals and things like that. We want to be there if things turn bad in the economy, or if things go in a negative direction. We want to make sure that that we're there. Also, with the ETFs, remember, it's a very small part of the market. The actual bonds give us a better purchase should we need it. We clearly don't need it now.